Burton Malkiel, a random walk down Wall Street?
Yeah.
Is that due tonight?
Come on, winners. It's due tonight at 12. I think you should spend more time doing your homework and less time dating.
Class. Class, I have not received your submission of the book review. Are you done yet?
No.
Okay. Class is empty today. Class president, where are the others?
The other groups failed the previous subject. They couldn't handle Wiley.
Oh, I forgot. I have to talk to the lecturer about this. Let's have discussion on the book so you can all have A's for this book review assignment.
What book?
Let's start. What do you know about the author of the book?
Burton Malkiel is the author of the book. He has a PhD in economics and finance from Princeton University in 1964, and he also has an MBA from Harvard Business School in 1955.
What is the book about?
The book is about investing.
Wait. Raise your hands, please. Jangan geremong-geremong. Adi?
The book is about investing properly for the long term. Or in the words of the author, how to get rich slowly but surely.
You, Ani.
The main point mentioned in the book are technical, fundamental, and modern portfolio theory.
Okay, let's go back a bit. What do you mean when you talk about investing? How is it different from speculating? Yes, Venus?
Prof, investing is purchasing assets to gain profits in the form of reasonably predictable income for the long term.
You, Ani.
Speculating is buying stocks, hoping for short-term gain over days or weeks.
Has speculating resulted in any serious incidents in the past?
Yes, Prof. There has been the tulip bulb craze and the South Sea bubble.
Adi?
More recently, the Japanese land and stock bubble and also the biotech bubble.
Are there any theories to explain why bubbles happen? Yes, Venus?
There is the castle in the air theory, where people are affected by hype and greed and join the action hoping for short-term gains. Basically, it talks about the psychological factors affecting buying and selling decisions. Without scientific analysis, someone will invest if they think someone else will buy at a higher price. This can lead to bubbles.
Are there any alternative theories to castle in the air?
Yes, Prof.
Yes.
There is the firm foundation theory, which is based on the belief that every stock has an intrinsic value. And the intrinsic value is calculable based on the earning that the stock can generate over a period of time discounted to present value.
So, for the modern investor like you, what can you use to play the game? Mario, are you still with me?
Sorry, Pak. What's your question?
How do you analyze whether to invest in specific stocks or not?
We can use technical analysis, Prof. Technical analysis is essential the making and interpreting of a stock chart based on the historical movement. Patterns and trends are identified and decisions are made based on this interpretation. Its practitioners are known as chartists or technicians.
So, why do people use technical analysis?
First, principle of technical analysis is that all information about earnings, dividends, and future performance of a company is automatically reflect the company past market price. Chart showing this price and the volume trading already comprises all the fundamental information, good or bad, the security analysis can be hoped to know. And then second principle is the price tend to move in trends. A stock that is rising tends to keep on rising, whereas the stock at rest tends to remain at rest. True chartist doesn't even care to know what business or industry a company is in, as long as he or she can study its stock chart. That's my opinion, Pak.
Very good, Mario. But what is wrong with the technical analysis? Adi?
Technical analysis is based on trends. By the time the trend has been established, it may have already been too late to act because market movement is very fast. Also, technical analysis techniques is self-defeating. As more people use and act on it simultaneously, the value of the technique decreases because trends will not be worth analyzing. Based on the above point, traders will also tend to anticipate technical signals in order to act earlier. This will ultimately skew the trend.
So, Adi, is there another alternative analysis?
There is the fundamental analysis. The fundamentalist concern is what the stock is really worth. To estimate the firm foundation value of a stock, the fundamentalist's most important job is to estimate the firm's future stream of earnings and dividends. The worth of a share is taken to the present or discounted value of all the cash flows the investor is expected to receive.
How do they estimate the value of any stock? You, Ani.
The four determinants used to estimate proper value of any stock are: 1. The expected growth rate. A higher price should be paid for higher growth rate of dividends or earnings. 2. The expected dividend payout. A higher price should be paid for shares of companies where larger portion of a company's earning paid out in cash dividends or used to buy back stock. 3. The degree of risk, higher returns. 4. The level of market interest rates offer a stable, profitable alternative to the stock market. Bonds will be a more attractive investment if rates are high.
Anyone that wants to argue with that theory?
Fundamental information available to analysts may be inaccurate or the analysis is incorrect. Secondly, even if the information and analysis is correct, it is virtually impossible to accurately translate the information into a single estimate of intrinsic value. Finally, even if intrinsic value estimations are correct, stock might still go down. Price for stock in the market can be influenced by market competition. If other stocks with the same level of fundamentals drop in price, market might readjust the price for a stock as well.
Can we use both technical and fundamental analysis together?
Yes, but there's three rules we have to follow. First one is buy only companies that are expected to have above average earning growth for the 5 or more years. And second, never pay more stock than its firm foundation of value. Third, the last, look for the stock whose source of anticipated growth or the kind of which investor can be built castle in the air. I guess it.
Does that mean that professional analysts who use them are always right?
No, Prof.
Yes.
There are also weaknesses to professional analysts, such as the influence of random events that cannot be predicted, and dubious accounting and numbers manipulation that can impact on the predictions of the analysts. The analysts themselves may even make errors. The best security analysts also usually do not stay in the field for long. And lastly, there may be conflicts of interest between the analysts and the investment banking departments, where they tend to encourage buying in order to receive commissions.
Given all these weaknesses, what does the author propose?
Maybe we can use modern portfolio theory, Pak. Usually we call it MPT, aims to reduce risk while possibly earning a higher return. MPT relies on the diversification to reduce unsystemic risk. Diversification for MPT involves choosing stock that have a strong negative covariance with each other. Low or negative covariance implies that the selected stocks or company do not parallel each other in terms of individual fortunes. Thus, selecting stock with low covariance for a portfolio set can help to balance and minimize the risk.
Mario said something about risk. What kind of risks are there?
Prof? Yes. There is systemic and unsystemic risk. Systemic risk captures the reaction of individual stocks to general market swings. Systemic risk cannot be eliminated through diversification because all stocks move more or less in tandem. Beta is sometimes used as a representation of systemic risk. For example, a stock with beta 2 will go up 20% if the market goes up 10%. A stock with beta 0.5 goes up 5% when the market goes up 10%. Unsystemic risk is the variability in stock prices peculiar to an individual company. These factors include labor issues, supply chain issues, contract agreements, and even fraud cases.
You, Ani.
According to IPMI and French, there are also two other factors we have to consider besides beta for systemic risk. We have to consider the size of the company measured by its total equity market capitalization. We also have to consider the value of its stock based on the market to book value ratio. Companies selling at very low prices relative to book value tend to be more risky.
And why should we listen to Eugene Fama?
He's a Nobel Prize winner, Prof.
That does not mean anything. Do you remember our first lesson? Eugene Fama had a student called Roy Sembel. Roy Sembel had a student called Jordan. You are my students, which means Eugene Fama is your great-grandfather. That's why you should listen to him. Does that mean MPT is bulletproof? Adi?
During the global credit crisis of 2007 and 2009, all markets fell in unison. Therefore, modern portfolio theory does not completely eliminate all risk.
We must also be aware of the impact of behavioral finance on how we manage our portfolio. Malkiel identified 4 points we should avoid doing. Number 1, avoid herd mentality. Number 2, avoid overtrading. Number 3, when trading, sell only losers, not winners. Lastly, avoid hot issues such as IPOs.
So, what are the most important lessons from the book?
Don't be greedy.
Invest for long term.
Ignore hype and rumor, sir.
Diversify to reduce risk.
As we learn from the book, the conclusion is that the best investment strategy is to invest in low-cost, diversified stocks on the market.
Prof,
Yes, Mario.
what is the meaning of random walk?
I don't know. You tell me. Adi?
Random walk theory states that future steps or directions cannot be predicted on the basis of past history. In the stock market, short-run changes in stock prices are unpredictable. Investment service analysis, earning forecasts, complicated chart patterns are useless.
Very good, class. Let's go for a break. And please come back in 30 minutes. Don't forget to submit your written review tonight.